All right. Thank you so much for joining. Today, we've got Danielle Holyoake with Amelia Risk, and we're going to talk about insurance. Danielle, thank you for coming.
Thank you for having me.
Great. So I think just to get started, we're just going to go right for the misconception to begin with, right? You think insurance brokers, and some people don't have the best connotations of those. So just can you describe in your words, what is an insurance broker? Why is insurance important? Let's just set the table.
Yeah, so I think it's a really good question. And I think there's a lot of mistrust in the industry with the insurance industry. And I understand why. So as an insurance broker, my job is to be the advocate of the insured or the brand, in this case, or the company. And my job is to represent my clients to the various markets, meaning insurance companies, and get the best terms and conditions and coverage and premium that is possible in the market for my client. I think that it's a complicated industry. I don't think we're very transparent as an industry. And so I think that it can be very confusing as a business owner to walk through this and figure out how to make the right decisions. And I think it's an area that as a buyer, you'll never quite be an expert, so you have to rely on them. Insurance is something you hope you never have to use. And when you do have to use it, it often doesn't go 100% your way. So I think it's frustrating for a lot of folks to walk through this. But that's why it's really important to get a broker that you trust that can explain up front how to make the right decisions, get you to be more educated about what you're buying and what you're not buying so that there aren't as many surprises down the line.
Yeah, I imagine that your line of work, you're doing a lot of education with people. I know that insurance is something that when you're paying for it, you're like, why am I paying for this? And then when you have it, you're like, okay, this is doing what I want it to do.
It's not a fun thing to buy. Even for me, I don't like buying it. That's not how you want to spend your money. And yeah, it can be hard to part with that money. And yeah, I think it can be hard to figure out what you need, how much you need, and you're gambling to some degree, right? There's certainly contractual requirements, you just have to do it. And then there's the you should do it stuff. And so it can be hard.
Yeah, that's a great delineation there. So can you talk a little bit about what are some things that you have to have, and then what are some of those optional things, and how does a startup navigate? Because I'm sure that those nice to haves are nice to haves eventually.
Yeah, so it can come in all different forms or for different reasons. I work with a lot of startups and emerging growth companies. So people come to me for different reasons or at different stages. The contractual requirements you'll see are things like if you have a co-packer agreement, that requires it. Hopefully you have an agreement and you have suppliers or vendors that are requiring it. Retailers are a big one. So hopefully you get into retail, and Target or Costco or Whole Foods is requiring between $1 and $5 million in insurance limits. Depending on the category, you might be even higher. So certain vendor requirements. And then there's things like workers' compensation. You don't have a choice. All 50 states require that you buy workers' comp when you have employees. You do have a choice when you're the owner, but when you have employees that are not owners, you don't have that choice. And then there's things like if you take investment, you may be required by your investors to buy certain types of insurance, like directors and officers. So it comes in from all different angles, and it depends on what you're doing and who you're working with and what your strategy to market is. And then there's folks that just come to me who are just concerned with the thought of being sued, and no one's requiring it yet, but they're curious. And so really what I do is I walk through where they are, who's requiring it, or why they're coming to me, and what their fears are. And then we kind of work from there to build a program that makes sense. And it definitely doesn't mean you get everything right away. There's no reason to. You grow into certain needs at different times.
That's great. When you think about mitigating for risk, right? That's effectively what insurance is. How do you help a startup determine if they should purchase insurance or they should self-insure? Like, where do they fall on that spectrum between, let me wait for a little bit longer to get to this threshold, or no, you really should have this given where you are as a business or the industry you're operating?
Yeah, so it's interesting because risk management consists of 3 different strategies. There's risk transfer, which is insurance. You're transferring the risk to another party. There's risk avoidance, which is just don't do the thing. And then there's risk mitigation, which are things like having really good contracts and beefing up your quality control procedures and things like that. So insurance is just one part of that. And as your risk management advisor, I'm talking to someone. I first start with, what is the products that you sell? Who do you sell it to? How much are you doing? Where are you selling it? Who uses your products? And what could happen if there's misuse of the product? If a toddler gets into this cosmetic of their parents, or the dog eats something, what could go wrong and how would people be affected? That's the first thing we do. And then I talk to my clients about, here are the things you can do about it from an insurance perspective. And these are going to be the costs associated with it. And then we talk about where on the spectrum of conservative does the client fall? Does this stuff keep them up at night? Because if it does keep you up at night, maybe you just insure it. If you feel like you can play a little fast and loose, maybe you wait a little while. And I think that there's some things I wouldn't play fast and loose on, like liability policies, such as product liability, but certainly an area where a lot of my clients don't insure right away. So they're taking on the risk of loss, meaning they're self-insuring, is inventory coverage. And that's insuring the inventory anywhere in the supply chain. So you may have product in Miami, you may have product sitting in Chicago, you may have product in California. There's different risks associated with those locations. It's very hard, as you can probably understand, to get insurance in Miami and in certain brush zones in California. So my client has $20,000 of product sitting in Miami. It's probably going to cost a good portion of that to insure it. So maybe you self-insure that $20,000. So those are the types of things we walk through, but there are some policies that protect against lawsuits that really shouldn't be self-insured, because defense can be hundreds of thousands of dollars alone.
Yeah, that's great. I think there's so much parallel here between just supply chain and what you're doing around risk management, because in supply chain, so much of what we get paid to do is to think what could go wrong and looking around those corners to try to figure out, okay, if a border is shut down, what's our backup, right? If there's a strike at a port, where do we go? And so I like how you frame this. First, think about, what would your worst day look like? If everything went wrong, what would it be? And then what's the outcome to that?
Yeah, and that's why people love talking to insurance brokers, because you are talking about worst case scenarios and no one wants to think about those things. But that's really what insurance is for.
Yeah, I remember growing up, there was a door-to-door salesman that my parents let in. He was selling tombstones and like grave plots. And I remember they're sitting at the kitchen table talking about this. The kids, what? Who's sick?
Yeah, right.
I think it's probably a similar thing here.
It's no fun. I'm no fun to talk to for a lot of people.
No, that's great. So talk to me a little about your journey. How did you get into this field and what led you to start Amelia Risk?
Yeah, I started in insurance right out of college accidentally. There's really two ways I think you get into insurance, and that is you have a family member that's in it and you just know that's one option, or you completely get into it by accident. And I was accidental. I started right out of college at an entry-level position in a small boutique brokerage. We worked with a lot of tech companies and private equity, and I really just started to love it. I think it was interesting to me from the get-go because it is an industry that there's not a lot of Main Street expertise. And so I was doing something that I didn't know anyone else that was doing this, and I thought it was really interesting. I've worked with startups my entire career. And then we were acquired, by the company I was working at was acquired by a very large brokerage. And that was really interesting. I stayed for 2 years after the acquisition. But ultimately, what I saw was that the large brokers don't really want to be giving the level of resources that startups need. As you can understand, small business is small revenue, right? And so there's a push to provide startups and small businesses with really one-size-fits-all off-the-shelf products. And what I had experienced my whole career is working with founders and educating them. And when you work with startups and emerging growth companies, things change quickly. Year over year, they could be providing dramatically different products and have different strategies. So you have to really be in touch with your clients throughout the year to understand how their risk is changing. My business partner, Liz, and she happens to be one of my best friends, We started our own brokerage. So we did that about 3 years ago. We started Amelia Risk, which is a play on the word ameliorate. And we started to be able to provide the true risk management services and consultation to startups. And there's a couple ways we could do that, right? One of which is just using better technology. The insurance industry is very archaic as a whole. And so using some better software for our process and our clients' processes has really helped us streamline a lot of administrative burden. And so that's what we do. And we work with mostly CPG companies. We also do work with a smaller percentage of tech companies still, but we really focus in those two niches. And of my CPG clients, many of them, probably 3/4 of them, are harder to place risks. Things like baby products and dog food and dietary supplements and functional beverages and foods. Those are considered high risk from an insurance perspective. So we're really doing a lot of bespoke custom work or handholding in that area. And it's a lot of fun.
Yeah. How does that work if you've got a high risk, hard to place client that is relatively small? I imagine that that's a very niche. How do you get the attention of the big underwriters yourself?
Yeah, it is hard for those clients because there's some things that insurance companies really like, and that is years in business. They want to see history. That is helpful for them to understand how risky something is, seeing 3 to 5 years of history in running the business. So as a startup,
they probably don't want 3 to 5 months. Yeah.
So you're already behind the 8 ball as a startup. So yeah, there's actually roughly two main markets in insurance. There's standard or admitted, and then there's non-standard or non-admitted. And the standard markets like pretty vanilla stuff. So all of the harder to place risks or more difficult, risky things are in the non-standard market. And that's a really cool market because they can do very custom things. They can manuscript endorsements. They have total freedom in how much they change rates for various things. There's a lot more flexibility in that market. So that's where we go for harder to place stuff. But you do have to find underwriters that are interested in small business. That's the key. There are minimum premiums in order to even write that business. So a startup with a dietary supplement that is doing $100,000 is going to pay probably 3 to 5 times as much as their friend with a cookie company that's doing $100,000 in revenue, because they're going to be in 2 different markets. And so a lot of my work is educating the client about why their product is considered riskier from an insurance perspective. And then we know, because we focus in CPG, we know which insurance companies are interested in what. So we approach them. And there's a handful that are interested in these types of products and that will write startups.
That's great. Keeping with that underwriting theme, what are some of the key aspects of a business that an underwriter insurance companies can look at to determine what rate they're going to charge?
Yeah, so it's a function primarily of 2 main factors. One is, first, we classify the risks. What do you sell? Are you a soap manufacturer? Are you a cookie company, dietary supplements, things like that? And by the way, even if you have contract manufacturers, if you're the brand, you're still considered a manufacturer. So if it's your label, that's how you're classified. So they first look at your product, and then they look at your revenue. How much revenue do you do each year? As you can understand, a $300 million revenue company is going to have a lot more losses or opportunity for losses than a $250,000 company. You just have more product in the marketplace. So as your revenue grows, so does your risk. And so an insurance company takes the classification of your product, then they apply a rate for that classification, and then they multiply the rate times your revenue, and that equals your premium. The other factors that go into it, though, are things like your quality control procedures. Do you have contracts with your contract manufacturers? Do you have contracts with your suppliers? Do you use only U.S. suppliers, or are you sourcing international ingredients yourself? Do you have a recall plan in place? These types of things are really important to underwriters, and they do look at your ingredients as well. And they also take a look at your website, your labels. How are you positioning your product? Do you say on your product label that you increase brain function or improve your focus and immunity? Those types of claims to functionality are considered high risk from an insurance perspective, even if it doesn't coincide with needing FDA approval or something like that. If there's claims to you will feel X if you have this product, it's considered pretty high risk.
Yeah. So in other words, it's what space are you playing in? And then what do you say you're doing in there? Okay. Exactly. What are some of the least risky, what are the layup type of industries or companies you say, hey, this is going to be basically free? And what are some of the ones on the other side of the spectrum where you're like, oh my goodness, nobody's going to insure you?
Yeah. Easy ones are like sparkling water in a can. That's pretty vanilla. Cookies, crackers, packaged things like macaroni and cheese, stuff like that. The harder to place anything in household cleaners is high risk. Anything in cosmetics or skincare or beauty is high risk. Anything to do with children or babies or pets is high risk. Then there's some random ones like canned fish. I didn't think we'd have a hard time placing that, and we did. There's a risk of botulism. Things like that come up, and I'm like, oh, okay, yeah, I can understand that, but I didn't anticipate it being a harder one.
It's just more of a pet gets hurt, people sue. I get that. And people probably aren't going to sue about macaroni and cheese. Is that basically what it comes down to? They look at how many lawsuits have been filed and they say, okay, these guys are going to have some litigation risk.
Exactly. And so the other thing too is like when people are buying a dietary supplement, they're looking to improve something. They're looking to fix something or improve something or get more of something. When you buy macaroni and cheese, you just buy macaroni and cheese. You're not interested in improving health, perhaps. So that's part of it, right? And they do, dog food is an interesting one, or pet food is an interesting one, because part of that is just that there's not the same controls around quality that there is for human food. And then, of course, baby food, right? Like we all get that. No one wants their baby to be sick. And yeah, it's a matter of how many claims are in this particular category and or how does this industry manage itself, and then how, like with the dietary supplements or functional things, if you see those ready to drink coffees or teas at the grocery store or 7-Eleven and they're saying you won't have the 2 p.m. crash when you drink this coffee, like that type of functional thing is different than I just picked up a cold brew. That's it. I just want the coffee. I don't care if I have a crash. So it's like, what is this product going to do for me that causes it to be a little bit more high risk? And then there's just some insurance companies don't like certain things because they got burned on something big recently. And it doesn't really have to do with the industry as much as where that particular insurance company might be feeling at that point.
That's great. It sounds like a theme here is that the better run your company or the better run your supply chain is, the lower the insurance costs are going to be.
100%.
Yeah. That's great. And I think that's certainly an area that as companies are moving into their first co-packer or their first factory, even scaling, if they don't have those strong quality controls, at least they don't have someone who can ask those questions. It sounds like not only can they have issues and risks from a product perspective, but potentially some legal risk as well.
Yep.
That's great. Sticking with the cost thread here, most people don't question insurance costs because they're not experts in this space. So how do they know if they're getting a good deal or not?
Yeah, that's a good question. I think it comes down to, do you trust your advisor? If you go to a broker and that broker explains a lot of these things, the more vanilla clients I have, the more straightforward that cost is and they don't question it as much. But the more difficult stuff is they're paying a lot more than their friends. So they do question that. And a lot of trusting that you have a good deal is having this conversation. Like, why is your product considered riskier? And what does that mean for you, in particular in the first few years? And then the other thing that really helps, makes you understand that you're getting a good deal, is seeing the market list. My job as a broker is to go to various insurance companies and say, what can you give me? Give me your best. And then I put together a list of approached insurance companies as the buyer if you're getting a list of 10 insurance companies that we went to, and 8 of them declined and said no thanks, and 2 of them offered quotes and they're relatively in the same ballpark, then okay, if only 2 out of 10 quoted, yeah, this is tough, right? Because there's insurance companies that don't want this. So I think having a market list and a broker that sort of explains the context of the market is really helpful. And then, yeah, asking around is helpful to a degree if you understand that different products have different rates and that size in terms of revenue matters tremendously. Then, and you have those 2 pieces of context, then I suppose asking around is helpful, but I think often it can be a little bit more confusing.
Yeah. How often is it something where you'll get a quote from a startup and you say, okay, you're paying this amount a month. And then you say, once you're at this size or you have a process in place, we're able to go back and we think we're going to get X amount of savings.
Yeah, things change all the time in the insurance industry, particularly for the harder to place risks in the non-standard market. You're going to pay more upfront than your counterparts in the standard market. And at a certain point, in terms of revenue and years in business, that starts to level out. You're not going to always be paying more. The more revenue you have, the more leverage you have. So insurance companies are more interested in a $15 million company than they are a $400,000 company because the premium is there. And the other factor that helps you is years in business. The more years you have under your belt, it opens up more markets. There's some insurance companies that don't work with anyone who hasn't been in business for at least 3 years, period. So once you've surpassed 3 or 5 years in business, you just simply have more options. So more revenue, more years in business, and you have more options available to you. So I would say largely it's that. The other thing is that appetites, the insurance company appetites change all the time. Every few years, we might revisit someone, even if they declined the risk this year, in 2 or 3 years, I might ask them again because they could say, yeah, we do write peanut butter. We used to not like it. We like it now. So things change like that too.
That's great. Just thank you so much for taking time. I guess just some closing thoughts here. What common pitfalls or mistakes do you see people make when they're negotiating contracts for?
I would say that the biggest thing I see is that people are only looking at price. They're looking at price and they're looking at limit. So like a $1 million policy or a $3 million policy. Not all insurance policies are created equally, and the devil's in the details. So it's really important to understand that the terms and conditions and coverage, like the actual language in the policy, the definitions of things really matters. And quite frankly, no one expects the clients to be looking through that and understanding that. So I would say finding a broker that you know is an expert in your space is really important. Because basically what I see a lot, the biggest pitfall is just looking at price and saying, this one's cheaper. I've seen clients have policies that have product exclusions for their very products, meaning they're paying a couple hundred to a few $1,000s a year for a policy that literally will not do anything for them. So you don't want to do that. It doesn't make sense. And I wish that weren't the case in the industry, but underwriters do it. They try to do it. They're not all malicious, but they're trying to collect premium and not pay losses. And the broker's job is to explain to the insured, to the client, this is why this policy is a good one, and this is why this policy is not a very good option, and try to negotiate those things off. So I'd say that's the number one pitfall, just looking at price and thinking, it says it's product liability, so it's the same as this one, because they're certainly not the same.
Danielle, thank you so much. I've learned a ton about risk and insurance, and this has been a lot of fun. Thank you so much for making time.
Yeah, thank you for having me. It's been great.
If people want to get in contact with you, what's the best way for them?
My email, Danielle at ameliarisk.com. That's AMELIARISK.com. And you can visit our website. You can email me, and I'm always available.
Excellent. Thank you so much.
Thank you.